It's pure panic out there. Stocks are crashing, crypto is imploding, rates are skyrocketing, and your 401k balance is dropping like a rock. In today's video, we look into the latest data suggesting that this may possibly be the nightmare scenario we were all afraid of, a recession far worse than anything we have experienced in our lifetimes, more harmful than 2008, and possibly more destructive than the Great Depression of 1929. This is not clickbait, this is the truth. In today's video, we analyze the various market forces pushing the finance world to the brink. With all these signs of a recession, I've been thinking about wealth preservation and diversification. Franklin Templeton Investment Solutions states that the search for protection and inflation hedges is rapidly driving investor interest in real assets. Real assets are not only uncorrelated to equities and fixed income, they are also far less volatile, so investors have the opportunity to get strong returns without having to go further out on the risk curve. One of the most interesting real assets from a risk-return perspective is contemporary art. On the same day as the collapse of Lehman Brothers, a two-day auction in London racked in far more than had been anticipated, a development that led many to believe that the high-end art market is bulletproof even in times of global turmoil. This market has outpaced the S&P 500 by 164% over the last 25 years and has even shown stronger performance when inflation is above 3% and during periods of monetary tightening, which is why Forbes reports that an art collection has the potential to rival the long-term returns of bonds. So when I heard about today's sponsor, Masterworks, I knew I found a way to prepare for the impending hurricane. After acquiring the artwork, Masterworks then files it as a public offering with the SEC, allowing investors to invest in a portion of the painting. When thinking about new platforms, track record is one of the most important things I look at, and Masterworks is very strong. Since inception, Masterworks has sold 3 paintings, each returning over 30% net IRR to investors. That means if you invested $45,000, you get $60,000 back. Although past performance is no guarantee of future results, I think this concept is super innovative, and I'm not alone. Over 450,000 people have signed up to date, and there is a wait list to get started. However, by partnering with Masterworks, you can skip the wait by clicking the link in my description to start diversifying and preparing in just a few clicks. Now back to our video. We start with the obvious. The S&P 500, as I'm recording, is down around 21% from its peak in December of 2021. That makes this downtrend the 14th worst in US history. That may not sound as bad as it should be, but let me remind you that today's drawdown is unprecedented due to a number of evolving factors. I don't have to remind you that this is one of the first market crashes where the federal funds rate was close to zero when the trouble began. You see, normally in the past 40 to 50 years, the solution to market trouble was easy. Have the Fed reduce interest rates, which in turn would jumpstart the economy, acting as essentially a shot of adrenaline for the markets. The Fed has always acted as the pharmacist whose drugs push the economy past its slump and back into overdrive. However, after years of abusing the drug of money printing and 0% interest, the side effects are finally showing up. You likely have noticed the high inflation occurring around you. By the Fed's own measures, we are at 8.6% inflation, and if we use the 1980 methodology, we would be at nearly 17%. This creates a massive problem that is plaguing the markets. You see, the Fed can obviously choose to do what it has done before to save the market, which is to cut interest back to zero and introduce a bunch of money printing programs, but this is no longer a viable option because it would further increase the already high inflation, potentially putting us on a path towards the worst case scenario, hyperinflation. This double-edged sword is now in the mind of every investor and institution. All the companies and various bubbles funded by this easy money of the past decade are coming to an end. Zombie companies are businesses that earn just enough money to continue operating and service debt, but are unable to pay off the debt, are on the rise. Even bankruptcies are popping up. The makeup giant Revlon recently lost 95% of its stock value after it was announced it was filing for bankruptcy. Looking over its most recent earnings report, it's easy to see why. The cost to service its debts exceeded the money it brought in by a wide margin, and the future looks even worse for them unless the business can miraculously turn around. In plain English, Revlon doesn't have enough money to pay off the interest part of its loans, let alone the principal. And if these rate hikes continue alongside with this downturn, we can expect more and more cases just like this. You can see this downturn evolving throughout the market. As you may already know, companies provide guidance or predictions about the near-term expectations for a business. This happens during earnings calls, which occur 4 times a year. You know it's bad out there when a company does an earnings call and before the next one can even happen, they issue revisions to warn investors of changing conditions. Target recently revised earnings suggesting a 60% decrease in business expectations just weeks after their Q1 report. Goldman did something similar, and the CEO of Chase, the largest bank in America, outright told the public to brace for impact as an economic hurricane was headed towards the US. There are tons of recession alarms going off, and this is all happening in an environment where prices continue to rise. The root of all power and the king of commodities, oil, is where you'll find the most obvious evidence for this. Crude is nearly double what it was last year, and this commodity has way more impact than just gasoline prices. Oil is used in plastics, clothing materials, and food production. Realistically, it's at the base of our economy. With gasoline, jet fuel, and diesel essentially transporting the bulk of everything we make and move, a doubling in the price of this super commodity is extremely bearish historically. Looking back at the data, every time there has been a 100% rise in the price of oil within 1 year, what followed is a recession. It was true in 1990, it was true in 2000, and it was true in 2008. Last time prices got as high as $146 a barrel before it all came crashing down, and right now we're close to surpassing this all-time high. On top of this, what many people consider the #1 recession indicator has already sounded its alarm back in April. The 10-2 yield spread has an unbelievable record in predicting bad times. Almost every time this chart has gone below that zero line, what followed is a recession. Back on April 1st, it dipped below zero for about 36 hours, and it wasn't long after that we had a negative GDP print and a plummeting market. 10-2 is back to plummeting, and it looks like we may soon invert once again. A shocking development that provides further evidence that we're entering a recession. But let's go back to the beginning. Remember, I said many people believe that this will be far worse than just a recession. This could be a complete meltdown like 1929. But before we head down that path, we need to understand a bit of history. 1929 cannot be compared to anything else that has happened in the markets for the past 100 years. While there have been plenty of recessions, massive drawdowns, panics, and corrections, there has never been an event that caused the Dow to lose 90% of its value. Had you invested during the peak, it would have taken you 25 years to get your money back. That's how damaged the markets were back then. Imagine a crash in 1997 that the country just today recovered from. That was 1929. It changed finance forever and lived in the minds of the American population for decades to come. What set it apart from other meltdowns is that the government did not step in and help or couldn't in the first place. By 1933, nearly half of American banks had failed and unemployment was approaching 15 million people or 30% of the workforce. In fact, the country wouldn't really recover from this economic knockout until World War II, where an epic buildup and a strong win on all fronts catapulted the US into a superpower. So let's lay out the facts here. What we have is a government unable to help bail out the economy this time around, an economy fueled by speculation, easy money, and credit. This massive super bubble seems to be popping, and with no support in sight and a massive economic catastrophe up ahead, how does the government fix this? History gives us a couple clues, and the stage has been set. Thank you guys for watching. As always, please make sure you hit that like and subscribe button if you enjoyed it.